Okay, folks, welcome back. This teaching is going to be specifically dealing with essentials to trading the daily bias. Okay, folks, we're looking at the dollar index. This is a daily chart, and I want to cover some essentials and my understanding about how to trade daily bias. Before we begin, just understand that this is not to teach you every single day, Monday through Friday of every month, what the daily bias is going to be tomorrow. I don't have that understanding for every single pair, but I do know how to find a bias across all the pairs. So as a scalper, I can excel by looking at using some of these concepts and obviously things that I teach in my tutorials, both free and in my paid mentorship. So I'm going to cover one or two things here that I think are paramount that'll help you at least try to get a hold on daily bias. So if I look at a daily chart, what we're trying to do is ascertain the likelihood of it being a up close or a down close day. Now, there's absolutely no guarantee of what I'm going to tell you here being accurate. So you always have to use that as a reminder because I'm human and you're human too. So you're going to make mistakes just as well as I can make a mistake and I can be wrong. So I don't want you to take what I'm stating here as the panacea be all end all to understanding what daily bias is. Because there's a number of things that we can do to get a better opinion about what the daily bias will be tomorrow or today, but it doesn't guarantee results that are going to be positive. So you always have to consider that, okay? But it's certainly some things that you can practice in a demo account and build your understanding about daily bias in the sandbox, if you will, of a demo. So I like to look for intermediate term and short-term highs and intermediate term or short-term lows. And what I have here is I have this high delineated and I have this low, these highs up here, this low, this low, this high, and this group of lows down here, okay, which is just an extension of this low back here. Now, I teach that when the market's not in a trending model and or a parabolic move up or down, the market's going to work off of traditional support and resistance theory. Now, the problem is which support and resistance do we use? So I look for the key turning points, the real obvious ones. Now, you can use these short-term ones in here, but the main one is here because the market moved from that low all the way up to this high, consolidated, tried one more time to go higher, failed, went lower. Found some support here, found resistance, found support, tried one more time, failure, the market moved higher. So we're looking at the ebb and flow of how the market moves from a point of overbought to oversold to equilibrium and consolidation, and a new move that would take us to an overbought or oversold condition. That's a range-bound market, which is where we're seeing the dollar trading right now. Now, it has a slightly bullish bias to it, and it has had that for a couple weeks now. But for now, I just want to just cover how I interpret. The first thing I look for is, are we coming off of a run above an old high that may see it trade back below it, or are we trading below an old low that may see it trade back above it? What I do is I look for these intermediate term price points and swing highs and swing lows on the daily to see if we have moved above an old high, because we could very easily reject that and trade lower, or if we trade below an old low, we could see it come back above it and stay inside the previous determined range. So if we look for candles or daily ranges that run above an old high, chances are we could see it continue going higher, but we also have to be mindful that we could see an eventual turnaround or reversal, and it could start to go back below that old high, because this could be very easily seen as a false break. Same way with the old lows, as we see here, the market does in fact trade through it, tries to make a lower low, couldn't do it, failed again, and then started to trade higher. So we have to have these intermediate term swing points on our daily chart because they're going to be potential reversal points, failing to follow through after breaking an old high or breaking resistance, or failing to make a lower low and trend lower after breaking below old support. So when the market's not trending, this is the scenario that it will typically trade within, which is a classic support resistance theory. The problem with support resistance theory is which high and which low and which resistance and which support do you use? So I start with these swing points like this, or turning points, where it could potentially be reversals. You can see how price eventually does trade above this high here, finds a measure of resistance, it consolidates. So we're in a point of equilibrium, and the market's digesting whether or not it wants to stay at these levels or trade higher or trade lower. As we see, the market trades below these lows in here, can't rally above, and collapses, trades below. It reprices all the way down below an old low, and then rejects, comes back into an area of consolidation, then rejects again, expansion, lower, finds a low, cannot find momentum through it, consolidates around it, tries one more time to go lower, then trades higher. Every time the market breaks a swing high, and if we look to the left of that swing high, where's the next old intermediate term high? This one here. So there's nothing for it to potentially reverse inside of until we get up to here. So if we're going to use simple classic resistance and support levels, we could see that this is the one we're going to be looking for. Okay, so if we're trading around here and we're looking here, this is going to be in the form of resistance. So the markets want to try to get back up to that level. The market does, in fact, try to make an attempt to do that, but when we have these ideas suggesting classic support, short-term resistance, okay, that's what this whole level is here. The market's tried to go through it. One more time, try to get through an old low, and then traded through it, back above this swing high here. So what I'm going to teach you is this is what I look for daily buys. Now, there's a lot of folks on social media that were looking for a weaker dollar, and ignoring these types of phenomena that I'm going to show you here, you're going to have that error as well. But if we know that there is a support level here, we tried several times to go below it, and then we had a swing high broken, what's the market really telling you? It wants to go higher. So what's the next level to reach for? This short-term resistance level. Okay, so we can see that it wants to get to 94.17. That's the high of this candle here. So what do we do at that point? Once we clear this high here, what's the bias? Well, if you look at this little diagram I have over here, this is going to refer to the previous day. Now, this could be a bullish or bearish day. It doesn't make a difference. But when the market is bullish, as we've outlined it over here, we're going to be looking for the previous day's high to be the target, and the previous day's low to be supported. In other words, there shouldn't be any movement below the previous day's low. It should all focus on the buy side. It means reaching for the previous day's high. When the market's bearish, this scenario would be reversed. We would be looking for price having an inability to get above the previous day's high and to seek the previous day's low. Using this criteria here, okay, once we broke this candle's swing high here, the daily bias on this candle, and this is a Sunday, we would look for Monday as well, and then Tuesday we would look for bullishness. So if we use this same theory, we're going to draw this particular candle right here is the one that broke the swing high, and then we know they have a resistance level it could probably reach for. So we're going to be looking for the next day to trade not to the previous day's low, but to and through previous day's high. So this next day, what's the daily bias? Here's the opening. What's the bias? It's going to want to reach for this high. So where's it wanting to go? Up. So what are we going to focus on? Previous day's low or previous day's high? Previous day's high, because it's bullish. It's wanting to go higher. So the market trades up, creates an up close day. Then we take the same thing and apply it to the new day. Okay, so we have a very simple approach. Take this little box and move it up here. Now we have yesterday, this is with this on this candle's date on the December 8th. This candle's last Thursday's high, which would be 93.80. Market opens, and we're going to see it trade through that. And with the anticipation, it's going to eventually try to reach for this daily high. So when this happens, again, we don't think about the daily low from the previous day. We're focusing on the movement through the previous day's high and or eventually reaching to this level here on the daily. The market closes in the middle of the range. Here is Sunday's trading. Then Monday, the same phenomenon. You would look for the market to want to trade through what? On Monday, we would look for this previous Friday's low to be supported, and we would look for price to run through previous Friday's high. Again, this is Sunday. We wouldn't expect anything there. Monday, we see it open here. A little bit of movement above it, but it does, in fact, pierce Friday's low. And it comes back and closes where it opens. So is there any significant change in the underlying direction? No. Did we trade to this high yet? No. So we take that same premise. Now we apply it to this candle, which is Monday of this particular week of the recording. And we see it open here. So what's the bias? We're looking for the previous day's high. Why? Because we have yet to trade back to this old resistance level. Market opens here, trades up, trades through it, but look what it does. It comes right back inside the daily range. Okay, in the next trading session right now, at the time of this recording, it's 9:26 p.m. New York time on December 12, 2017, and the candle is already starting here. It opened, had a little bit of movement up, and now we're moving a little bit lower. So it may want to trade a little bit higher, go a little bit higher through this old high, but as we're reaching for these intermediate-term levels on the daily chart, we're factoring in, does it have enough range to reach for it above or below? And then we take that approach and apply it immediately to the previous day's high and low, as we have here. And what you're determining is if we're bullish, we're going to be focusing on the previous day's high for momentum. And when we're bearish, we're going to focus on the previous day's low for momentum. Very rarely do you see both sides of the previous day's candle tagged or traded through. If it does, it's usually indecisiveness or it's going to be a reversal soon, and they're clearing the board on both sides of the marketplace. And when you start seeing those types of things, get prepared because the market could be, in fact, about to reverse. You can see that actually happening here. Previous day's high and low here. The next day, it trades through it, and its low is violated too. So we're about to see a reversal. Next day, reversal. Okay, and I'll show you another example of that. Let's see here. We have it here as well. We have a Thursday's range. Now this low comes in at 94.42, and the low in here is 94.42, so it's equal, but still very close to the high. This is Sunday, and then Monday, nothing shown there, but we end up getting a very important high eventually afterwards. And this is called an outside day, when you have a previous day's range that's violated with well, this is an example of it too. This high is 93.98 and the low is 93.67. This candle's low is 93.58 and the high is 93.99. So this is an outside day with a down close. That's typically bullish. Reason why it creates a false break above the previous day's high and then closes on the low. If we're in a bullish market overall and that occurs, generally sets up a really good buy scenario. I've learned that from Larry Williams, and that's from like old school stuff. But you have to have a context behind it. You can't just take a outside day with a down close and just naturally assume it's going to be a bullish day. But you can see it does, in fact, give a huge opportunity to be a buyer on this day. And my application of outside day is when it does that, it sets up a potential short-term reversal. What Larry Williams brought to the table with it is it creates a short-term oversold scenario. So it doesn't necessarily mean it's a reversal. It just means it's many times a continuation pattern, according to his definitions. All right, and here's another scenario here, outside day. We have the candle here. The high comes in at 93.23 and the low is 92.81. The very next day, the high is taken out 93.24 and the low is 92.75. So reversal day. and then we can see the market does in fact want to trade higher as a result. So you won't always get the outside day at turning points, but I like to look for it because it builds a lot of confidence behind it. And by using these tools, okay, and when the market also breaks more or less a swing high of importance, and we have a level that doesn't have anything else until we get to here, it's bullish. Okay, it's bullish. Avoid this whole scenario like looking at this high to this low, pulling fibs on, looking for optimal trade entry, and sell off and all that stuff. It's already shown a willingness to want to go below this low multiple times, and then it broke a swing high. So the momentum is bullish, and that's going to reach for this. Now, if we're doing that analysis on the daily for the dollar index, and we've arrived at a bullishness for the dollar, what does that translate for foreign currency in terms of daily bias? It's going to be a mirror image. So if we go over to the euro dollar, we can see that the euro dollar has been bearish, as we would reasonably expect. Notice that every single day, the daily high is not concerned with at all. It's the previous day's low. It trades through it. So now we have a low here. What's it going to do? It's going to want to trade through the previous day's low. It trades through it. So what's the next storyline? Opens, trades down below the previous day's low. Next day, what's it going to do? It's going to trade through not only the previous day's low, but what's it really reaching for? That old intermediate term low on the daily. I'll give you some lipstick on the chart so you can see that. Frame it out a little bit. So you have this low here, and its price is starting to drop down. It's reaching for this level here. Why? Because it's basically the opposite of what we're seeing done here. The dollar's reaching for this intermediate term high, while the euro dollar is reaching for an intermediate term low. Each day, we're focusing on, again, this phenomenon here. We're focusing on, for the euro, because the dollar is bullish, we're focusing on the previous day's low, and that's where it's going to be aiming for. To it and through it. That's how you think about it when it's bearish. Back to the euro dollar. Every single trading day, opens, creates a small little tail, power 3, Judas swing, sell it, down close, reach for the previous day's low. Next day, opens, false rally, Judas swing, sell it, reach for the previous day's low, does it. Next day, opens, rallies, false rally, Judas swing, sell it, fade it, reach for the previous day's low. Boom, handled. Next day, opens, small little tail, trades lower, comes back off of the low, okay, but we're still targeting here. Okay, we're still reaching for that. The next day, well, this is going to be Sunday. So here's a Monday trading range. It opens, rallies up, gets a short-term overbought scenario, comes off the highs. That is a potential reversal scenario. The next day, same skit. We're looking for what? The market to open, trade below the previous day's low, and then ultimately, if it trades through that, forget Sunday, go to Friday. It trades through Friday's range, and then ultimately reach for this low here. So we're looking for that scenario here, potentially to trade through this low still is there. And so the daily bias today on December 12th, 2017 should be a move lower below this low using what I'm teaching you here. Okay. So hopefully this has been insightful to you guys. It gives you a little bit more framework to work with. And obviously there's so many things that we can build on to build bias and intermarket relationships as well. But I try to incorporate the application of the dollar index analysis and also to justify what we would view in terms of foreign currencies, bullish or bearishness as well, and using daily bias. Okay, folks, hopefully you enjoyed this presentation. If you like this presentation and you want to find more, you can visit my website at theinnercircletrader.com.